Hello, I am Lisa J. Stocks. Thank you for tuning into this week's Stock Talk episode. And we're going to be talking about ETFs. Some new, some more established, some foundational, some very uh, niche, and that could potentially have a lot of growth in the future. So let's get started. There's a lot of ETFs out there. There are thousands to choose from. And one of the ones we're going to take a look at today is something new. It just came out last month, and that is ticker symbol DRAM, which is the Roundhill Memory ETF. But before we get into this, let me just talk a little bit about making sure that you are on track to build long-term wealth, and making sure that, as always, I want you to encourage you, since I don't want anyone to get into investing, have a bad experience, get turned off to investing. So we are definitely going to work on, or I'm going to share my journey and my experience so that you're building a strong foundation, so that you're creating something that is long lasting and going to help you to truly achieve your goals in a way that is not scary, that is not hard. And so let's talk about it. AI infrastructure, AI in general. I think if you've been here before, you must have heard me talk about Nvidia. It is something that I invest into as an individual stock. When I go through my, several of my ETFs, it is going to be a leader. It's going to be in that top 10, if not number one on the list, because it is the company with the largest market cap. So I see someone in the chat here is saying that they recently heard about the ticker DRAM, the Roundhill Memory ETF. It just came out. I'm going to get into the details of that. So let's get started with today's picture. This AI infrastructure boom. There are several different things that work together to help when it comes to AI. The data centers. I put out a video a couple of days ago. Someone had asked me about energy ETFs, and so I tried to touch on, I think, about 5 different ones in that video that give you exposure to different areas of energy. And so I want you to be aware some of these ETFs have higher fees than our basic VTI, VOO, or FXAIX, some things that you might be doing in your children's accounts, in the Roth IRA, or even if you're in your own taxable accounts. So another thing I am, adamant about is making sure that you really make sure what is the right fit for you, that you think about what is the, what expense ratio warrants the performance and the expense ratio, making sure that the balance is truly there for what you are trying to achieve. Because I think a lot of us have lost money over time, especially when it comes to our retirement accounts. Even through our employer, what we might have been defaulted into, we've lost so much money by not being mindful, by not being aware, in order to not be in these investments that are eating away at our performance, these that are robbing our performance and our long-term growth that could be going on in our portfolio. So guys, thank you for tuning in. Make sure to hit that like button, as Thrive and Glow with Joe has reminded us to do here. Like, share, comment, subscribe, hype my videos when you see them throughout the week. Always make sure you leave a comment, even if it's just a quick emoji. So I'm about to click the end stream button. That would be a mess. Hello, good morning, Cruising Fun Anytime. I don't know where you're at with the morning time. It is 3 p.m. Eastern Standard Time for me. Okay, so we're going to be taking a look at some ETFs. First, I'm going to go through a few. I'm going to go back to DRAM, I guess I'll call it, and some others. But first, I want to touch on some more established financial anchors that have been around and have a longer track history. So I'm going to start off with something basic. We might have heard of it. I think it was recently included in the share split that Vanguard had. or the, yes, I'll say share split. No, technically you're supposed to say stock split or share split. I've been saying share split when it comes to the ETF. But Vanguard, VGT, the Vanguard Information Tech Index Fund. So this one year to date, up 11.28%. It has an expense ratio of 0.10%. So you can think of that as $10 on a $10,000 investment. So keep that in mind when we're touching on the other expense ratios of some of the other funds that we're going to be taking a look at. So this one's been around for about 22 years. It's going to give you exposure to those big companies, like I mentioned, Nvidia, Microsoft, things like that. And so this is something affordable, proven, you have a long track history to take a look back on. Now, one that I recently incorporated just this year into my portfolio is SMH. Another one, it's been around since 2011, so a bit more of a history for us to reflect back on. Now, year to date, this one is up 41.57%. It has an expense ratio of 0.35%, so higher, but I took a look at the long-term performance, those top holdings, a more concentrated fund, something very specific that I wanted additional exposure to after I had already started out building out positions into Nvidia and Taiwan Semi and AMD. I said, going forward, I think I want to find an ETF to lean on for additional exposure. So I just recently started, very small position so far, maybe 2 shares, but something that I want to continue to build on. And then another one, this is not specific to this semiconductors, but another one that captures momentum of different industries that I've been incorporating is SPMO. And so that is Invesco's S&P 500 Momentum ETF. And let's see what this one is doing year to date. Year to date, up 12.66%. Now, this one, it captures what's working right now. So at times I'm going to get that exposure to some top, names, whether it comes to tech, semiconductors in this fund. It's tracking by momentum. So these are some more established companies, ETFs that I've incorporated to get exposure. But now we're going to go on to those newer ones that I want you to be mindful of. I'm not discouraging you from trying to seek out those diamonds in the rough. Whether it comes to an ETF or a individual stock, but I want you to be smart about it. I want you to realize that things need to prove themselves. This fund, it just came out April 2nd, 2026. So brand new, 1 month. When I'm putting on year to date, really year to date, as I said, April 2nd, that's the whole history of this fund. So it came out April 2nd. Its initial share price was $27.76. And overall, it's basically at its high. Its high has been $40.79. So we're just shy of its high as far as what it has shown us in just the 1 month that it has existed. So this is, let's see, I have some information over here. So this primarily holds global memory semiconductor companies. So it's a very targeted exposure to these companies. Let's see if we can put it into, do I have it up? I usually do. Put it into ETFRC. I don't even know if, see if any of the names are even familiar to us. Like we see, is it not in here yet? It's not in the database. I guess we'll have to see if I can look it up. I'm not even sure what the top holdings are and if they would be familiar to us if we did take a look at them. All right, yes, a couple are Micron Technology, Samsung Electronics have heavy weightings in this fund. So it's a pure play, but it's very new and it's very expensive. And I've been seeing a couple of other, I've been seeing it in the news and whatnot. And so I just wanted to touch on it because I'm not, like I said earlier, I don't want to turn you off and think, oh, we just have to invest into blue chip stocks, things that have a 10 plus track record. But I want you to be mindful of if you incorporate something this new to stay on top of it. Make sure to mitigate your risks, do your research, make sure that you believe if you have some high conviction in something like this, that you're getting in tune with those top 10 holdings or, the top holdings of the fund to take a look at those companies' performance to see if you are really going to be capturing the gains that you want for your portfolio by investing into this ETF as opposed to choosing one of those individual companies to invest into directly. Because, as I said, this one has an expense ratio of 0.65%. So significant. You think of that as $65 on a $10,000 investment, as opposed to a VGT, which is a $10, 0.10% expense ratio fees against a $10,000 investment. So you have to do what's right for you. But I wanted to touch on this. Let's see. Let me take a look at these. I really like listening to your advice. My granddaughter works in financial services. Okay. It's crazy how you're talking about this because I picked it up at $36, 100 shares so far. Wow. Wow, Noelle. Okay. So Noelle has already shown us that I'm not sure if you're a she or a he. I think she is correct. Please correct me. Because I've known people, I think both genders with that first name of Noelle. That you are showing you have he. Okay, I apologize if I said that incorrectly. That you're showing that you have a strong conviction. So let's see. All right. So it's one that I wanted to highlight and bring to your attention if you had not heard about it, so that there are thousands of ETFs out there. It's a matter of finding the right fit. And just because of, I'm sorry, lost my train of thought there. Just because you hear about a particular ETF that tracks something, for example, the S&P 500. I use this one as an example often. There are different ways to get exposure. So just because you do your research, do your comparisons, because there could be another ETF that is a better fit for your needs, is what I'm trying to say. S&P 500, you don't have to, definitely never go with the SPY. SPY has an expense ratio of 0.09%. I trade the SPY. I do not invest into SPY as a go-to. There's no reason for it when there are other funds like VOO. There are index funds like FXAIX or even SPYM that have lower expense ratios that are going to give you the same exposure, and there's no need to pay that higher fee. We're just regular everyday investors. Even, there's no reason that you need the liquidity, that you have to reach out to that you need security of investing into SPY as opposed to a lower cost fund. But never financial advice. I'm just sharing my financial journey and my thoughts. So let me take a quick second to acknowledge Chad. Thank you so much for that $10 super chat. I appreciate all of your support of the channel here on YouTube, in the Discord. Can't stay for long. No, I had to show support for the illest in the investment game. Thank you so much, Chad. I appreciate that. So let's talk about a couple of others. But guys, let me go back to the chat. Oh, I still am on the chat. Let me know if you have any questions specific to DRAM, and we can try to take a look and work those out while we are here on the live. But I'm going to touch on a few others, but this one just came out April 2nd. So it's something that you might have heard of, something you might have been thinking about. And I just want to make sure that you just don't jump into something like this. Like I said, no proven track record, no 10 years to reflect on. Get in tune with all of the different aspects of a fund. How often does it rebalance? How does it go about, paying dividends and all those different things? So I think I put these in. Let's see. Where is my favorite tool? And guys, I'm sorry about if anyone was looking for my live on Friday. I put it up for 1 o'clock and then I changed it to 8 p.m. and I still was unable to make it both times because it was prom day and it was hectic and it was a long day. And then when I went to revise it, I thought I had hidden it and it was still up there. All right, so year to date, or 1 month actually. Okay, so let me take this down. Okay, so here's a look at some of the holdings. I already mentioned Samsung, Micron, ScanDisk is another that might be familiar to you, but there's not too many that are familiar to me. So what are your guys' thoughts on this? Noel has already let us know, built that position. Do you have a, do I have a preferred brokerage account you go with? I'll give you two for long term, well, I might give more than two. I have multiple accounts for multiple reasons. For the long term, I do everything at Fidelity as far as like my daughter's investment account, business account, my retirement accounts, Roth IRA, all those type of things I do at Fidelity. And then outside of that, taxable accounts for trading, right now I'm doing all of my trading on Webull. I've become accustomed to it for options trading. It's where I know how to do it the best, and that's also where I have a lot of my growth portfolio. But you can see in my links of all of my videos, I do have a referral link for the MooMoo Investing app. And that is somewhere else that I have been building an account for several years now. I have my dividend focused investments there. Great as far as right now, if you sign up using my link, you'll get 8.1 APY on your uninvested cash. I do my taxable account there. But after that, after the first 3 months, your APY does go down. But I like the app. I find it to be a great place to do research, get news, get detailed information in one screenshot. So I love it for those reasons, as well as it's been easy for me to have that flexibility of buying fractional shares, building up my portfolio there. So, and they haven't associated anything like over at Webull. They put on something recently where you have to have be in a certain plan in order to continue to get your APY on your cash, your uninvested cash that's there. I like that MooMoo still has that available, that you're getting basically the same APY you would at your high yield savings account. You're getting that over there all of the time without having to be in a higher plan. So I hope that wasn't too long of an answer, but thank you for the question. Thank you for tuning in. Hello, Rod. Okay, so I like DRAM and think that what AI needs is memory and storage going forward. With MU needing a pullback, it might dip, but still like it going forward. Okay. So it seems like this was a topic that you guys already had on your minds, or an ETF that, even though it's only been around for 1 month, that it's catching attention, and it's something that you might feel that you want to have exposure to, even though it has a much higher expense ratio. I'm buying this on Monday on any dip. Okay. This is okay. So what's in this fund? There is a Korean semiconductor company that is coming up right now. Okay. Hello, Daryl. I see you in the chat. Maybe I'll add 10 shares to begin with. Money Eyes. Is someone named Money Eyes in the chat? Am I missing it? Okay. All right. So let's take a look at another, a little bit more established semiconductor or AI power infrastructure investment. I'm going to add it on here alongside with the DRAM, and that is AIPO. So, Defensive AI and Power Infrastructure ETF. Is this one that's on anyone's radar? Have you been investing into this one? Let's see. Now, this one has been around since last year, summer of 2025. So, a little bit more history here. But again, one with a high expense ratio of 0.69%. So, be mindful so that you're making sure not to lose out on, if there's something with a lower expense ratio with similar exposure that you could save on, especially, the performance needs to be in line with the charges, with the fees that you are going to be incurring by holding these long term. So this fund, year to date, AIPO is up just a little bit less than DRAM in the 1 month that it's been around. It's up 41.86%. Another that overlaps a lot with the fund that I'm in, but we're coming down on the expense ratio when we come over to this one. SMH, I'll throw SMH in here also. So that's the VanEck Semiconductor ETF. But next, we're going to take a quick look at QTUM, and this is a quantum ETF. And so, year to date, even though DRAM has only been around for 1 month, it's still leading as far as the performance. So SMH is up 41.57%, and then the quantum ETF that I just added is up 23.51%. And this is a short time frame, as I was saying, like trying to highlight when it comes to DRAM as a very new fund, take a look at those companies within the top holdings, do your research on them to see how they have been progressing, what their forward guidance is. This is something, as I was mentioning, these are the type of things, if they are stocks that the detail is in the MooMoo Investing app, you can get a lot of detail. You can get the analyst ratings, you can get the revenue, you can get the balance sheet in a way that I think gives a lot of detail. So you can do your research on them as individual companies to bring back to your to use as a way of determining if you want to go forward with incorporating the ETF, because ETFs is one thing. If I invest directly into Microsoft or Meta, as opposed to an ETF that's highly weighted in them, which those two companies, I definitely know I can find something that's not going to have those high fees. But once it's in a different realm, like semiconductors and the things that we're talking about here, AI hardware, AI infrastructure, then you might have those higher expense ratios. So you might want to consider a little more in detail as to, do you want to invest directly into the company, or do you think for your goals and needs, it's best to stick with the ETF with these higher expense ratios for the long term? Because the longer you're in it, the more fees you're going to get charged as your portfolio grows. So how much do you believe in analysts' opinion? I think it's easier to, there's certain ones, Bank of America, there's certain ones that's another thing that you can take your time to find analysts that seem to have a proven track record. Overall, you take it with a grain of salt. Their news and different things are going to shape how a company, the direction of it. You can't strictly go by that, but they are knowledgeable. They are evaluating. And if I see analysts are downgrading a company, I'm going to take that into account and go and do my research, especially if it's a company that I'm holding as an individual stock. So how much do I believe in it? I do believe and value the opinion, but I also take so many other factors along with it. Okay, let me take a look. My plans are to load up on DRAM with 200 shares, but build a position with SOXX as a main play or position. Okay, so SOXX, that's one I think kind of pretty similar to SMH. I have done a video doing a comparison of those two companies, those two ETFs. So another one where you definitely will get lower. So it's the iShares Semiconductor ETF. So that one has an expense ratio of 0.35%. So pretty much in line with SMH at 0.35. So basically half of what you're getting with some of these newer ones. And let's put in this other one that's Jeremy. So iShares Future AI and Tech ETF. So stock price, $62.82. Expense ratio, 0.47%. And let's just click into it and see exactly what it's all about. Mostly invest into stocks based on a particular theme, which is AI and tech. The fund tracks a concentrated index of global companies that provide products and services that are expected to contribute to the artificial intelligent technology. Okay. Holdings are selected and weighted based on market cap. And so this fund has been around since 2018. So one with a more proven track record, but again, take a look at those fees and let's go out to a higher time frame, even though there are some on here that are not going to be able to really give us any because they are new. I put this onto the 10-year, 10-year, and going out to that time frame, SMH and SOXX are leading. SMH with 1,700% and SOXX at about close to 1,400%. So we don't know. 10 years down the road, DRAM may be in the same position that we're seeing these more established funds, but at the same time, could you potentially just go with one of those now and continue the same wave that they've already been riding? Or do you want to have exposure to both to kind of give yourself different angles and different exposure to different areas of AI? Okay. Taking a look back at the chats. All right, so did I add in AIQ is another one that I had in my notes to take a look at. And that is a Global X Artificial Intelligence and Technology ETF. You see, there are so many different angles that we can get exposure to AI, energy, anything, So when you want to have certain exposure, do your research, do sit down, find the top holdings, find those companies that you want to have that higher exposure to through investing into an ETF as opposed to that individual stock. And then from there, take a look at how these companies rebalance, like I said, how they rebalance, how they pay out their dividends, how they go about what the weighting is, how they determine all these different things. Then you might easily be able to find a fund that has a lower expense ratio, maybe a higher dividend payment. Most of these funds are not dividend payers. They might have a small one, but the difference could be something that you want to consider. So performance and expense ratio are really the keys that I want you to pay attention to. Okay. So guys, let me know your thoughts on what we're taking a look at here. This last fund that I just added in here, AIQ, another one with an expense ratio of 0.68%. So these are all 0.35 and up, drastically different than the VGT that we looked at the beginning of the live with a 0.10% expense ratio. So can we add in more onto our list so that we can have something basic like that? And maybe go down a little bit on the 3-year. So over the last 3 years, VGT is up 117%, while SMH is up 302%. So growth tech as opposed to semiconductor focus. There's so many different ways that you can go about building your portfolio. But before you get into all of these, with, like I said, these higher fees, you have to think about it as a risk reward kind of a thing, more volatility. I definitely would have someone getting started out is start out with the S&P 500. Or if you were me, I had to go about building and coming back to kind of building out my foundation. So what I mean by that is, like when I got started with my daughter's portfolio, I knew if we're investing $100 this month, $80 are going into these funds and $20 are going into these individual stocks. But when I started investing on my own, whether it was building my own taxable portfolio or reinvesting monies that I had in a previous 401k, I sometimes wasn't doing each investment with that structured percentage. So if I was going about investing or helping someone to get started with just getting started building a portfolio, I would have them maybe out of $100 doing $40 or $50 into their foundation, total US stock market, S&P 500, then maybe choosing some more aggressive growth investment, an ETF for growth, then an ETF sector specific, something like we just been looking at today as another smaller percentage, 5-10% into something that's going to have that more volatility, but potentially and historically higher growth. but we want to make sure that we're building, getting those steady dividends, reinvesting them. You're definitely going to get that from an S&P 500 or total US stock market investment. And then from there, if you are ready, then incorporate individual stocks, again, at those smaller allocations. But me, I started investing and, was going all in on individual stocks. Then said, I need to work on my foundational stocks. So I had to kind of mix it up. But now I have structure. So I go about it in the way that I'm describing, an easier way of just being able to build up. So SMH are your wife's initials, shaking my head. And I was in someone's chat and I was talking about it, and that they thought I was making jokes, not talking about a ticker symbol. I'm going to put 1K into SMH tomorrow in my rollover HSA Fidelity. Okay. I will be investing into SMH also tomorrow. I think for now, that's still going to be one of my daily investments. I did do a stretch. I've been keeping up with it, but I did a stretch starting late January. I was doing $10 a day into SMH, and that was my initial start into having that in my portfolio. It's in one of my IRAs at Fidelity also. What's the difference between investing and gambling? Michael Parker, do you really need to answer this and help you with this? Listen, investing is something that we all need to do. It is something that we need to take seriously. It is a way to build wealth. I know there are other ways. There are real estate and other different businesses that many people have created for themselves that they're able to profit from. But overall, I'm talking to the regular, teachers out there, the regular corporate America people, people that may work in different industries where that 401k or 403b are not built in for them. You need to take investing seriously. As soon as these babies are born and they have their social security number, we can start investing for them also. And so we know how hard it is right now. We know that it is a different world out here from what our parents and grandparents lived, as far as buying a home, having long-term stability in their careers. It is totally different out there. So whatever we can do to give ourselves security in retirement, give our children a head start, this is what I'm here encouraging. And don't be scared of investing. We have to realize that it is a roller coaster ride at times, but we have to not be fearful. I encourage you to not be fearful. Take everything into consideration. Take this administration, take the war tensions, geopolitical tensions, tariffs, news, all of these things into consideration, so that you're factoring that in and you're not afraid to invest. You're realizing, taking the time to go and review the news so that you have an understanding of what happened. What happened last year, April 4th, 2025? Can you guys tell me in the chat what happened last year, April 4th, 2025? Why is this a significant dip down on the chart? Okay, so we know that we see the recovery that occurred after this, but you can't be fearful when we know a certain event is right around the corner. We have to be, we have to be ready for this. We have to be able to realize that we have ups and downs. We've gone through, COVID-19. We've gone through things. We've gone through 2018. We've gone through different crises, and things that were very specific that we might have been our first time in our lifetimes going through them. So don't let the opportunity to invest pass you by. Know what you're investing into so that you can understand that after the dip comes the recovery. The whole US stock market is not going to fail us. And so realize what you're investing into and keep moving forward. And don't, I'm going to keep on saying this because I really want to get this message out. If you are working for a company, you get started working at the company, or if you've been there for years, take a look at all of the investment choices available to you through your investment plan. Often we are defaulted into a target date fund or something that is underperforming, something with high fees. Make sure that you are in tune with this so that you can make improvements because this is you. This is your hard-earned money that I want working for you. I've been through it. I've had this experience. And so I tell you, if you guys are familiar with any of my videos that I've shown, I got my money from empowerment. I fled from empowerment over to Fidelity, which I've already talked about today, which is where I have my long-term accounts, several different types of accounts, but definitely all of my retirement accounts are there. And I invested into FXAIX, a lower expense ratio than any fund that we've taken a look at today, 0.015%. So that would be $1.50 as opposed to the funds that we were taking a look at here. So where I would be paying $1.50 in fees, we have DRAM, which would be $65 based on the percentage that we're seeing here. So let me take a look at the chat. Having patience while the Mag 7 stocks are running is so difficult. I don't know what you mean by that. It's difficult to continue to invest because you think you missed it, you missed out already, or I'm in a target date plan and we'll look to get out. Was there a cost in transferring from empowerment? That's where mine is as well. So I'm not saying that you necessarily have to get out of a target date fund. Let me just elaborate on that a little bit more. I would love for us all to at least be able to take advantage of our employer plan, especially if there is a match. Now, in my experience in a company that I worked for, we happened to be using Fidelity is where my 401k was while I was working there. And I was in a target date fund that corresponded to my age. When I asked and when I inquired and got in touch with Fidelity, there were other investments that were available to me, other funds that I wound up transferring my contribution while I was at that company and staying in the target date fund. I left what I had already contributed into it, but then I changed my contribution going forward 100% into FXAIX, which is the S&P 500. So it's just a matter of me asking, going into the Fidelity. There's two parts to Fidelity. I can't remember what it's called. Well, there's a going into the Fidelity account, call up, get assistance. They're there to help us. Very, very good customer service there. But once I went in there, I was able to do that and was in a fund, better performance, tracking, giving me that direct exposure, low fees to all of those big names, the Apple and Nvidia, Microsoft, Google. So it was a better fit for me. And another way that you can do that, if you are strictly limited to a target date fund, and I've touched on this before, is using a target date fund that does not correspond to your age. For example, 10, 20 years beyond. So for someone much younger. So I'm saying if you're 45, be in a fund for a 30 or 25-year-old, because those funds are going to be more into stocks. I wanted to be in a fund that was 92% into the stock market. The stock market was thriving. We had 2 years back to back with over about 25% when it comes to the S&P 500, for example. So I knew I wanted to be heavily weighted into stocks. I don't want anything, even though I am older, I don't want anything that's shifting me heavily into bonds and underperforming things. I'm still in a place where I want to capture that growth. And so that's another direction that I've been able to go about. And I've had people share with me that they agree, and they've shared their personal experience in taking a look at their investment account and finding that they were in something that was performing less than a high yield savings account. There's no reason for that. Why did you get a 2 or 3% return on your investments, your retirement investment, in a year when the S&P was up 25%, when individual companies like Nvidia and Google have been thriving? There's no way that should occur. So you have to have your eyes open to it. Now, another part to this question, I hope this person is still here, about transferring from Empowerment to Fidelity. Make sure that you're in contact with both sides when you're going about making I didn't need to take that down. I have to take this down. When you're making the move. So what I did was I opened a IRA over at Fidelity. And so then I got back in touch with Empowerment. So the Empowerment was sending the money. I wanted to make sure the money was staying invested. I was not touching it. It was just basically going from one retirement account into another retirement account. So I opened the account, basically Empowerment sent it over to Fidelity. I was not hands-on with it. It's just once it got over to Fidelity, it was then just sitting in cash. And so I had to go about investing it on my own, getting it reinvested once it got over there. But there was no, as I recall, I don't think there was any fees. My biggest concern, and the message I want to make sure that I'm clear with, is that you have to make sure that you're not taking it, because I don't want you to incur any fees or taxable events, that it's going from Empowerment directly into your new whatever you need to open up, depending on your circumstances. It may be a traditional IRA or something like that, or may need to do type of rollover, but they can give you direction on that. But I don't think they charge for that. Yeah. So rollover. Yeah. So Nora was seconding what I'm saying here. But yeah, in my experience, it's been a few years now that I fled from Empowerment, but I really did not want to I was slow on making the move of, giving up my account at Empowerment. And I wish I had done it sooner, because I spent time. I had numerous phone calls and, whatever, Zoom calls. I was really sitting down with them, trying to comb through every available investment over there. And like I said, this is maybe about three years ago, or 3.5 years ago. I couldn't find anything there that compares to the funds that I can build with over at Fidelity. So it's my go-to. It is definitely one of my go-tos, as I mentioned earlier. So great points with the transfer info. Yes, don't drag your feet on it. Don't be intimidated. And I don't want you to do it because of convenience. I surely didn't do it because of convenience. It wasn't bothering me to have accounts at Fidelity and accounts at Empowerment. I knew where my money was. As long as I know where it is, my family knows where it is. But yeah, I couldn't find a good fit. Those fees, the performance, the available funds, that's what matters to me. And I truly was able to find that over at Fidelity. Okay. So has everybody given the live a thumbs up today? Are you commenting on my videos throughout the weeks? I think I put up a poll question. Has everybody answered the poll question? Lisa, he's asking if it costs money to make the transfer. Okay. Great points. Yes, yes, I understand. Rod. Thank you, Sledge, for tuning in. Happy Sunday. Hi, Anthony. Okay. And just to mention, I think I hope later on this week I might do a video on that account that we've been just talking about, that I brung over from Fidelity, no, from Empowerment to Fidelity, because I'm pulling it up right now. Let me see. I'm going to tell you the exact number. That account now, I've grown it from down in the $120,000 range. It is now $199,320. So I am just shy of 200K in that portfolio. So when I hit that 200K, I may do a video showing what's in there, another update on it, and that's, another milestone, another portfolio, just hitting one of those milestones for me. Because yes, I am building for retirement. So Marlene, my friend Marlene, hi Marlene. So guys, again, if you guys were looking for us on Friday, I'm sorry. It was prom day and I was just a scatterbrained mess. And then between getting ready for prom during the afternoon time and then in the evening, early evening, the pictures and getting her and her friend ready and stuff, and I fell behind on my work that I was supposed to do. So even pushing the live back to 8 p.m., I still wasn't able to make it. But she looked gorgeous and they had a great time and they got back home safe. Okay. Hello, Nemo. Okay, Google stock. What about Google stock, Nora? What about Google stock? Do you want to look at Google stock? I love Google stock. Google stock happens to be, I would say, out of it's the best performing individual company that I have in my growth portfolio. Now, at times, Tesla was it, but yeah, Google has overtaken it. I'm glad you are adding my portfolio. I answered the poll. I am home now, so I should not miss any videos. Okay. Google stock. Okay. So Google. These companies right now, what they're doing, I think Google actually surpassed Apple recently. Oh, there it is right there. Is this on the screen? Yeah. Okay. So Google has moved up. It is the second largest company in the US. So usually, I think Google surpassed Microsoft and Apple to make this move recently. Am I right, Nora? So and it's close. It is 4.6 trillion, and Nvidia is 4.8 trillion. So, guys, Google is on its way. It could surpass Nvidia and be the largest company in the U.S. So, one that I am glad to have some exposure to in my portfolio. I definitely have been working on Microsoft and Meta, but I like everything else, I'm in the building phase and definitely would not mind having more Google, even though I am up significantly. Like I've shared with you guys, I'm not about holding on to any averages and things like that. I'm about moving forward and still building when it comes to my portfolios. So I don't know if I have any. So Google in the last 5 years up 227%. Let's see what it's done in the last 6 months. 6 months up 36%. So 1 year. 1 year, Google's up about 135%. So that is a significant move in that time span. And I know I recently, what did Dirty Wallet, Mr. Noel share that I missed? Oh, I'm doing the same thing right now, transferring my account to Fidelity because of lack of performance fees and more hidden fees. Now I'm going to self-direct my accounts now that I am retired at 50. Congratulations. That is awesome. Yes, it's popping. Yes. So I don't know if I have an image handy. Amazon. This will probably be from a few days ago. I'm not sure exactly what date, but it's probably similar to where I'm at currently. So on this particular day, which I think was pretty recent, I was up 147% when it comes to my Google investment. And my average price was 138.89. So 26 shares. Similar to my positions that I have in most of the Mag 7, but this one I definitely was concentrating on dollar cost averaging a couple of years back when it was like between $140 and $160. I wasn't jumping in. I don't have that to put in every week or every couple of days, but I was being consistent and I just kept on building, and I was able to get this much invested. So my contributions is 3,600, but 5,000 of this is gains. So when it comes, and this is in one of my taxable accounts, outside of retirement, outside of my retirement accounts that I can't touch until that 59 and a half age. So that was when I must have been doing a video and shared that in there, but let me take a look at where I'm at currently in real time. So what was it? I just showed you 147. Yeah, I swear this screenshot is not from long ago. I'm looking at my actual account right now, and my Google stock is up 177.44%. My market value now is over $10,000, and I'm quite sure this is from just a few days ago that it was at 89. So let's take a look at Google on a shorter time frame on the last month. So let me add this back, add to stage. Let's just back it up. So 11%. So look how it shot up even on April 29th to April 30th and just kept climbing. So that screenshot that I showed you, it wasn't old, but the gains that we've had in the last few days have pushed me up another over 10% from what I just shared. So this is what I want us to realize for ourselves, and teach the young people around us. We can't just be putting money into cars and just this is where we need to park our money. We need to park our money into quality investments. If you don't know how to pick the right individual stocks, find some low-cost ETFs that are gonna at the same time capture this growth of these blue chip stocks. So, of course, if we look at a VOO or something like that, something that tracks the S&P 500, we're gonna see the same. We're gonna see that. Right now, I'm not sure if this site, how often it updates, because like we were just looking at with the market cap. Google is now number 2 when it comes to market cap, but this site, maybe I'll have to do a lookup on that on what do you call it? I might have to go on like Chat GPT or something and find out how often, or if it's because we're looking at this on the weekends, why it is that Google is still, down here in 5th place when we can see that the market cap of Google has surpassed Apple and Microsoft recently. But the whole point is, whether it's, Nvidia, Amazon, Meta, all of these companies, Broadcom, which I believe Daryl was just mentioning in the chat a minute ago, these are companies that are going to be there to pull us up, whether it comes to the S&P 500, the total U.S. stock market. Those are the ones I mentioned to be your foundation, but they are often going to be in your VUG or VGT, depending on how, if it is definitely a tech-focused companies, which many of these are. So this is where we need to park our money, is the point that I'm saying. Instead of just having that money sitting in my savings, you have to have a balance. I want us to have savings. I don't want us running into credit card debt and not being able to pay it, but put your money into companies where your money can double, triple, make moves like this. And so this is what I want for us. This is why this is investing. This is not trading. This is not gambling. This is being mindful, realizing that these companies are thriving and still on track for additional growth. And so I want to be there to capture it and be a part of it. And it's for all of us. It's not for those that were born wealthy and born with the knowledge. We can gain the knowledge. And I want us not to be intimidated. I had someone recently, yesterday on Friday, actually asked me, well, how much do I need to get started? And I'm like, I'm not going to give you any number. I'm not going to give you a number. I'm not going to tell you if you only have $100. I don't, you tell me what you have. And I want to see you get started with what you have. What you truly have to get started with investing is enough. There is no limitations. There's no limitations when it comes to opening your high yield savings account or getting started with opening an investment account. If there are, the bar is very low. It's not, you don't have to have thousands in order to get started with anything that I talk about here on this channel. So don't think you have to be held back. When I invest $5, it's not a joke. I can turn on those to be recurring investments. I'm usually very hands-on. So once I make a commitment, I'm going to know to get in there and do my daily investments. Because Fidelity, they don't allow for daily auto investing. You would have to do it, weekly or bi-weekly as far as your deposits and investments if you want it to be done automatically for you. But I am a person that will go about it daily. So, okay, I'm going to take a look at the chat. And guys, I hope if you guys have asked any questions that I have answered them. Noelle, thank you for the support with that $5 super chat today. And I think I missed another one. Joe, Thrive and Glow with the Joe. Thank you for tuning in. Thank you for being a channel member, mod, and just everything you do to support this channel. Nice gains. Nora, do you have any gains you want to share on your Google investment? Are you a Google investor? Heck yeah, what? I have no idea what I was saying at this time. What time was this? 3:59. How long ago was that? That was 6 minutes ago. Okay. Apple will do its thing too. I think Apple will definitely, hopefully, wake up, because they have a lot of advancements and a lot of AI spending and, growth to do. And Let's take a look through the chat. Let me go down to the bottom. Okay, so Marlene and Joe, I don't save money in the bank anymore, only stocks, ETFs, and crypto. Okay, yes. I mean, I have to have some amount of savings, which I do in my high yield savings account. I do have a little bit of money, money market account, CDs, and stuff like that. I'm telling you, it's just strictly to just get me going so I don't have to sell my stocks in order to deal with, a more substantial car repair or home, issue that I'm dealing with. But other than that, I want my money invested and growing and working for me. Other than outside of that, so a new journey I want to get on is the mortgage payoff. So that's what I'm doing with my money. If it's not working for me, it's paying down that one basic debt that I have, which is the mortgage. Other than that, I want my money growing in the market, and I want to be reaping the rewards of what is going on currently. So when it comes to Apple stock, I'm currently up 79.61%. So, I mean, still good. I'm still pleased with the growth that I've had on Apple. But yeah, Google has really surpassed it. Tesla is stressla. It goes up and down. Sometimes Tesla was up significantly a few months back, but yeah, Google, for me to be up over 170%, I said 177. My Tesla stock has now cooled off. I'm down, up 73, where I know I have it in two different portfolios. I know recently my Tesla was up like 120 to 130%, but it's always up and down. But I'm willing to hold on to something kind of different. It doesn't have the fundamentals are hard to tune into when it comes to Tesla. It's not as easy as it is to analyze as a Microsoft or a Google. All right, so I'm taking a look through the chat. Stressla, yeah, I call it stressla. And I don't discourage people from investing into it. I had someone recently ask me a question. They said they had one share of Tesla and basically wanted to know, well, what should I do? Should I keep on adding? And I showed them my position. I told them, when you look at the fundamentals, like I think I might have used a company like I just mentioned, a side-by-side comparison for them to say, it's not there. It's not a cut and dry thing for me to be able to show you where Tesla's going. It's just a matter of the potential of the company that we can't as easily track and see because they're often having struggles with their inventory, with tension between Elon and Trump. Who knows what could happen? Lots of different things outside of our control. But I believe one day the autonomous driving, the robots, and all those things will be flourishing. And so I'm willing to have a position in it. Not as large as I'm going to have in my ETFs and other areas that are more easily able to, we have a better understanding of. So up 409% on 20 shares of Intel. Nice. So are you putting a stop loss on your Intel, or is it something you're definitely holding for the long term? AMD and Intel moves were incredible. Yes, they were. AMD, another one I wish I had more of. And they have their earnings coming up this week. I didn't post the earnings calendar. I've been a little bit busy, but I will post it as usual on my community wall if you guys want to take a look. But Yeah, AMD. I was talking about AMD last Sunday on the live. When AMD was at 305, I was like thinking the first number wasn't registering to me with me that it was at 305. Next thing I had just looked and it was 270. Then it's 305. Now I think it might be what, 370, right? It went as high. Let's see. 360. So now this is one. I have a small position of this directly. Like I said, I have AMD, Nvidia, and some Taiwan semi, but these are all three of those companies are ones that I'm going to get exposure to, and SMH. So in a higher concentration, more, higher weighting than I am through my S&P 500 investment, for example. Lisa, are you doing Mag 7 ETF and individual Mag 7 stocks? How do you fund the two? I am not doing like a top T or something. I don't have any investment like that. I don't have an investment that's a direct Mag 7 ETF. I do not. I invest into all of the Mag 7 as individual companies. And how do I fund? How do I fund the two? I mean, I decide what my budget is. I contribute to my retirement accounts are first priority. And then from there, a few years ago, I decided to start investing outside of my retirement account, as well as, building something for my daughter, just because I realized that I wish I would have had the money mindset that I have today, that I wish I would have had it back in my 20s and thought about, I need to invest so that I can retire early. I don't even think retirement was something that I was thinking about. I thought, you have to work. You have to work until you're in your 60s. I wasn't thinking that the better the how you go about investing, how you go about building businesses, buying real estate, and all those different things can allow you to retire from corporate America, retire from working for someone else. Even when I'm not working for someone else, my other endeavors cause me to have to work for myself. But I wish I would have known that. I wish I would have seen that example of the more you work, the harder you invest, the more work you put in when you're young, that you could potentially be retired in your 30s or 40s or 50s. So, but yeah, I mean, it's my earnings and that's it. I mean, and some people have commented that it's redundant that I have the S&P 500 and then I invest into Nvidia or Apple, but as you just saw, my S&P 500 investment is not up as significantly as my individual investment into Google, for example. So I'm willing to do both. Like I said, I want to. However, I use different analogies usually to explain it. You have the anchor, you have the boat, and then you have the sails. And so you have to think about your investments in that type of way. Like, what is, something that is going to be steady and strong? You have no fear that is going to recover. And then where are you going to have the growth? Where are you going to have that extra movement? And then those sails up on the ship, where are you really going to capture those really high moving, like I decided to incorporate SPMO, momentum. So where are you going to get all these different areas? And you don't have to do it all. I happen to do it all, but I'm doing it in a way, and I'm trying to structure it in a way that gives myself that stability that I want and keeps me comfortable and on track for my goals. And in time, I will be shifting this in order to, when I think the time is right, I need to make my portfolio more conservative, more more structured to generate me income. But right now, I'm still focused on growth, and my investing might have to kind of be put on hold a bit in order for me to get on some other things, like I mentioned with the mortgage payoff. So, but in time, that will give me just less things to have to worry about in the future and free up more money that can then go again back into investing. I'm waiting for the SpaceX IPO. Okay. We all do. We do. Yes, I know, right? Same here. Okay. Well, you already said that you are retired in your 50s. So you're doing the thing. Let's focus on that mortgage payoff. Yes, that's something that Marlene has already accomplished, and many of her siblings have already accomplished. So someone that is definitely an inspiration on achieving that. All right. So guys, let me know if you have any questions, or if there's any other ETFs or individual stocks that you would like to pull up. If you have any questions about anything that I'm holding in my portfolio, let me know. And if you're not already, consider becoming a channel member. Membership, you can click on my page and you will get all the details on that. It's also always in the description of any of my videos and live streams. As I mentioned earlier, if you're ready to open up a new account, I have my referral link for the MooMoo Investing app. It is an app that I've been using for many years now. They also have pretty good customer service. I've enjoyed my experience, good research tools, strong APY, especially for those of you who are opening up new accounts. You get that bonus for the first 3 months. So consider opening a new account, fund it, click on the link and take a look at the details. And also, if you are interested in learning about options trading or different aspects of investing, being a part of a larger community, you can consider joining KGU, which is Keen and Grace's Discord. There's also a link for that. So guys, hey Big Stacks, did you give the live a thumbs up already? Make sure, take a second, double tap the screen if I'm on vertical, or take a second to close out of the chat and just go give the live a thumbs up. Make sure you're always doing that for all of my videos, shorts, whatever you see come across your screen. Yes, like number 11. 11, that's pretty low. How is Walmart doing recently? Okay, let's take a look. What is that, WMT? Walmart year to date. Let's put up Walmart. Let's go through Walmart. On the 5-day, up 1%. 1 month, up nearly 4%. Let's go to year to date. It's up 18.12%. And year range. So it's a little shy of the 2026 high, or the year range. The high is 134.69. Walmart has really made a comeback recently, because I remember it wasn't that long ago. See, Walmart is the 9th largest company in the US. It wasn't that long ago that I was doing a video, and I wanted to just talking about the S&P 500 and how it rebalances for us. And I was saying that I think it was back in maybe in the 80s or 90s that Walmart was, at the top, like number one or number two. And then it had dropped down into maybe about the 25 place as far as the largest companies in the US. And now sometimes it's back up there around the top 10. So it's a company that really has had a comeback. But that is the beauty. I was using it as an example because that is the beauty and that is the simplicity and advantage that we get by investing into ETFs. They're going to rebalance for us. And, it's going to always have us on track to having exposure to those winners when it comes to our portfolio without us having to do any work. Now, as we were looking at earlier with the different companies that we were taking a look at, where is the, here it is. The companies that we were taking a look at earlier with DRAM and AIPO and, these different funds. It's just a matter of making sure that that expense ratio is what we're seeing on is worth the performance that we're gaining from investing into these funds. Has the war affected Walmart? I'm sure the war is going to affect everything because, with the war, it's going to trickle down in different ways. So I can't say that there's any company really that it's not going to affect because, we need gas. We need the gas is used to get the products to wherever it goes, whether it's plane, whether it's trucks, all these different things. You have to think of it on a basic level like that. Everything is going to be affected because whether the tariffs, whether any way, shape, or form that the cost of your product is impacted or the cost of transporting your product is impacted, everything is always going to trickle down to us, the consumers. So. Yeah, I'm doing vertical and regular live stream. So the likes that you might be seeing could be different on both on each of the different live streams. But I try to always make sure I like to do both so that, I might get into the short stream and get some new people here. If you are new here and you've been enjoying today's discussion, I hope that you subscribe to the channel and come back again. All right. So anything else on Walmart? Daryl? I want to buy more AMD, but I don't want it to drop on me with a pullback because it's so hot. Yes. Oh, you have to just think about it, do your research, find out what you're comfortable with, and think long term. Think long term because I wasn't thinking like that when I was originally investing into Apple, for example. You have to don't. I'm not going to let certain prices today turn me off because I'm not at the end of the road at 2030 or 2032. I'm barely going to remember these stock prices. So I just need to keep on moving forward and not think that, I'm done. I'm done with investing into Google, Microsoft, Apple, because down the road, they could continue. There are certain companies that can continue to flourish. And so I have to just think, am I going to be holding on to this for 7 years, 10 years, 20 years? Think like that so that you're not discouraged on continuing to build on something that you want more exposure to because of today's price. And 5 years ago. So yeah, I had an average at one point. I had an average on Apple that was like $120. Let's see. This is December of 2022. It was $130. And let's see here. $131. So yeah, I had a low average on Apple, and I took a long break from investing into Apple. Thankfully, I was investing into Tesla and Google and Amazon and other things. But when I look back at my history, I took a long stretch. I want to say maybe 9 months. Didn't add a dollar into Apple. And not that I have all that, my budget is what it is, but I still could have given Apple a little love and attention. Maybe $15 a week, even something just to keep building. No, I totally stopped investing into Apple. Had 120 average. I've since got back to doing a little bit of investing into it. But the whole point of what I'm trying to share here, my average now on Apple is $155.93. But the point is, whether 120 or 155, Apple is now $280. So I'm not going to stand still and stop investing and while something is continuing to thrive and grow. And, I'm just going to be left behind. So it's okay to keep on building if you see that a company still has the fundamentals, the moat, the people are still, linked to that ecosystem, all these different things. So I will keep buying and DCAing into the market. My HSA is at 37K and I will never spend it. Okay. It is aggressively invested. I know that about you. You don't want to hear about anything that's slow moving as far as the investment. You have AIQ? Okay. I want to buy more. Okay, I already saw that. Yeah. And yeah, Noelle, I know how you feel. I feel it too when with AMD, for example. I feel the same. But you might feel like, wow, it really took off. But I felt the same with Nvidia. This is another one I often use as an example. I decided, I think it was, not sure what year it was. Was it at the beginning of 2025? Well, it was at the beginning of one of these years, 24 or 25. I decided one of my new investments for the year is going to be Nvidia. And I start dollar cost averaging into Nvidia like on January 2nd. This is before the stock split. And it was maybe about $450, $500. I start dollar cost averaging and it just kept on going up. I could barely find a day. And, before I knew it, a couple months later, it was like $1,000. And I didn't let that, I've been through it. I've been through it in the past. I didn't let that discourage me. I said, oh, well, I have to keep going. This is the company. I want it in my portfolio. I made the decision. I'm disappointed. If there was one that I could go back and lump sum invest into, it would be Nvidia. Just take a few $1,000s out and just say, let me just jump in head first with this one, as opposed to daily or weekly building. But we can't see into the future, and so I'm not going to beat myself up about it. I'm glad for what I've been able to achieve, and I'm just going to keep on going. Every time I stop believing in a company, it runs another 1,000%. Oh, I don't know I stop believing in a company. I hope that doesn't mean you sell and then it runs. I'm not sure what that means because, maybe that's a sign to you that you shouldn't be selling. You should maybe, choose a percentage drop and then sell out and rebuy in if necessary, but you have to know when you're investing into something else. And with the fund that I touched on earlier today, which was kind of the highlight of the show, which was DRAM, ticker symbol DRAM. 1 month old, 1 month old, something new. So you have to do your research based on what the holdings are. But there could be this one is tied to volatility, but it's a group of stocks still. It's not betting all on one individual company, but you have to know it depends. Your experience in investing is dependent on your starting point. If I would have gotten started investing into Amazon, for example, 25 years ago, I would have went through a lot of pain in those early years before Amazon was profitable, before it was a household name, before it was on your street every time you look outside. But those who were investors way back then that stayed invested until today, their gains must be insane. So you have to realize, and you have to just keep up on the what is going on with the company. Most likely, you're not going to get in on a company that early. Put a substantial enough amount of money into it for it to be impactful. But some people do, and they luck out. But it's just a matter of finding the right balance for it. And right now, when it comes to Amazon, because as I said, I do hold all of the Mag 7, in different amounts when it comes to my portfolio. I'm up 74.87% on my Amazon, but I more so invested into Amazon in, I would say, the last 3-4 years when were already established. They've been through so much, with developing with AWS and branching out. They're still branching out into different areas. They're developing into pharmaceuticals, deliveries, and just so many different things. So you have to know at what stage of a company you get started investing, because that also is a way of determining what's a good fit for you. SanDisk, yes, that is definitely one that's been making headlines lately also. But we can't invest into everything. I don't try to chase every individual stock out there, so that's another reason I have to lean on my ETFs to get exposure in order to have, like I said, an impactful, a meaningful position in the things that I want to have exposure to. Never bet against Apple. I'm not. I haven't given up on Apple. I've never taken profit or sold any of the companies that we talked about today. Any of the Mag 7, if anything, what have I sold some of? I sold some Disney. I sold all of my JetBlue. I sold my Ford. None of the Mag 7 have ever been cut from my portfolio, or I haven't had the need yet to take any profit on them. When I invest this, what are you saying here? When I invest, the stock tanks, but I put money in and let it ride. All right. I'm going to be wrapping it up for today, but guys, thank you for tuning in. I hope you enjoyed today's show. Last week, I think I was talking about a company another company that I had a bad experience with that in addition to ChargePoint, and this is it. I couldn't remember at the time, but this is it. It's Jaguar Health, and I just put it on the 5-year. It's down. It's down 100% in 5 years. So, guys, like I said, I don't want you guys to not discouraging you from finding the diamond in the rough when it comes to, you know, an ETF, when it comes to individual stocks more so. Most likely that's where you'll be thinking about it, but be mindful, mitigate your risk, do things in a way where you have a clear understanding if something is an investment or if it is a trade. Be willing to let it go. Don't hold on to an investment and let it do this to you. I don't want you to be holding on to something like this and have any fear or, you know, bad feeling, bad experience that is impacting you long term when it comes to investing. Because we can win. We can win. We can be in the Google stock, winning over here, getting, you know, when you think it's already been flourishing, and then in a 5-day time frame moves up like this. So, okay. So thank you for catching the replay. For those of you that got in late, by tomorrow, I can't do it today because I have AI write the chapters for me, but I usually try to add chapters on the day after the live. If you do want to come back, if you got in late and want to pick up where you think you might have got into the show, you can do that. And also just in general to help you navigate the different topics and things that we covered on the day. And yeah, guys, thank you for chatting. Thank you guys for tuning in. Thank you. Thank you again to Chad, Thrive and Glow with Joe, as well as Dirty Carpets, aka Mr. Noel, for the super chats and for being here and being a great support to this channel. Okay. All right. So I'm going to wrap it up for today, and I will be back. Is next Sunday Mother's Day? I will try to keep to my schedule every Sunday, 3 p.m. Eastern Standard Time, but always feel free to drop me a comment on any of my videos. You can comment on this live after we're done in order to let me know if there's any, you know, things that you want to see in future live streams. But I'm wrapping it up for today. Have a great rest of your weekend, and I will see you next Sunday. And make sure when you see my videos throughout the week, make time to watch, like, and leave me some comments.
And to investments, she made a lot on YouTube. Lisa J Stocks. Lisa J Stocks, that's the channel. Hey. If you wanna make some money, visit Lisa J Stocks. Yeah. You will make a lot. If you wanna make some money, visit Lisa J Stocks. Okay. She'll make it pop. If you wanna make some money, visit Lisa J Stocks. Yeah. You will make a lot. If you wanna make some money, visit Lisa J Stocks. Hey, she'll make it pop. Lisa J Stocks.